Look at these two identical stacks of $10 million. On a ledger, they carry the exact same mathematical weight, but the process used to acquire them separates a lucky gambler from a skilled investor. If your goal is to simply match the market's average return, a completely passive index fund will get you there. But to generate superior, risk-controlled wealth, you have to actively beat the market. The problem is the universality of the profit motive. Capitalism ensures that millions of highly educated professionals, equipped with massive computational power, are all competing relentlessly for the exact same edge. Academic finance defines this environment through the efficient market hypothesis. This theory argues that because so many participants are analyzing the same data, the price of any asset instantly absorbs all available public information. According to this model, attempting to find mispriced assets is a mathematical dead end. But total market efficiency is a rebuttable presumption. The legendary investor Howard Marks built his career on the reality that efficiency routinely fractures at the extremes of human emotion. Exploiting those fractures requires what he calls second-level thinking, a rigorous, non-consensus approach to evaluating reality. True investment alpha, the measure of skill independent of the market's natural ratas, is not generated by a single secret formula. It requires constructing a precise first principles framework, layer by layer. If you do exactly what the crowd does, you are mathematically guaranteed to get the crowd's results. Beating the consensus requires thinking independently of it. The foundation of this framework is intrinsic value. Before making a single transaction, you must establish an independent anchor of what an asset is actually worth. Consider the classic thought experiment of the finance professor and his student walking across a university campus. The student stops and points to a $10 bill lying on the sidewalk. The professor doesn't even look down. He states confidently that the bill cannot possibly exist because in a perfectly efficient market, someone else would have already picked it up. The student simply bends over, picks up the $10, and buys a beer. This illustrates the gap between academic models and market reality. Intrinsic value is not a theoretical abstraction. It is calculated by measuring tangible variables, physical assets, hard cash flows, defensible patents, and capable management. When academics call a market efficient, they actually mean the market is incredibly fast at pricing in the consensus opinion. They do not mean the consensus is correct. A rigorous intrinsic value calculation is your only intellectual defense when that consensus inevitably panics. Once value is established, you move to the second layer of the framework, price. This scatter plot illustrates the most common trap for professional analysts, confusing objective company quality with investment viability. A world-class company generating massive profits drops sharply in investment viability if you are forced to pay an exorbitant premium to own it. The late 1960s provided a brutal demonstration of this reality through a group of supposedly invincible stocks known as the Nifty 50. Investors believed companies like Xerox and IBM were so dominant that their purchase price was irrelevant. They drove price-to-earnings ratios up to 90. When reality reasserted itself, these stocks collapsed, erasing 90% of investor capital. The companies remained exceptional. The prices were simply wrong. Investing is the discipline of relative selection. You must continuously weigh the current asking price of an asset against your calculation of its intrinsic value, comparing it against every other option in your feasible set. Buying an excellent company at massive premium is a reliable formula for a disastrous return. Conversely, as the adage goes, an asset that is well bought is already half sold. We now transition from static mathematics to human behavior. The third layer is cycles and psychology. Because human beings are emotional and inconsistent, markets do not move in a straight line. They operate like an enormous iron pendulum, constantly swinging past the center point of fair value, driven to the extreme edges by euphoria and depression. The greatest financial errors occur when participants look at a long upcycle and convince themselves that the pendulum has permanently stopped swinging. They extrapolate a temporary trend into infinity, declaring that this time is different. The 2008 credit cycle proves this perfectly. Years of economic stability and cheap capital slowly eroded institutional risk aversion. The desire to capture yield overwhelmed basic diligence, leading directly to the collapse of entities like Lehman Brothers. When the pendulum snaps back toward fear, leverage creates a mechanical crisis. Institutions face margin calls and are subjected to forced selling. They must liquidate their assets immediately to cover debts, entirely abandoning any regard for intrinsic value. The crowd's willing suspension of disbelief during a boom creates the exact forced liquidation events that generate the steepest discounts and the greatest opportunities for alpha. To survive those liquidations, we require the fourth layer, risk control. This standard bell curve represents the academic definition of risk as mere price volatility. True risk control shatters that definition. For a practitioner, risk is not short-term fluctuation. Risk is the probability of a permanent loss of capital. Furthermore, risk is endogenous. It is generated from within the market itself. When the collective consensus believes that an environment is entirely safe, lenders remove protective covenants, and buyers accept flawless pricing. The belief that risk is absent is precisely what drives systemic risk to its absolute maximum. Investing is structured much like amateur tennis. It is a loser's game. In professional tennis, the winner hits brilliant, unreturnable shots. In the amateur game, the winner is simply the player who keeps the ball in play and avoids making unforced errors. Survival dictates the outcome. This requires navigating two specific traps. Errors of commission occur when you succumb to greed and buy at the euphoric top. Errors of omission occur when you succumb to terror and fail to buy at the depressed bottom. Risk control demands patient opportunism. When asset prices are fair and there is nothing particularly clever to do, the urge to artificially force a brilliant move is the most dangerous risk of all. The final structural block before the peak focuses on separating genuine skill from random luck. As Nassim Taleb outlines in his theory of alternative histories, we judge the quality of a decision based solely on its outcome. A highly dangerous, illogical gamble that pays off due to a freak occurrence is still a terrible decision. The failure to separate process from outcome leaves investors blind to mathematical impossibilities. The Bernie Madoff fraud thrived for decades because clients looked exclusively at the positive bottom line, completely ignoring the mechanical impossibility of his stated returns. Madoff claimed to deliver equity-level gains with the volatility of a government bond. His performance chart was a flawless, upward 45-degree angle. In a dynamic global market, that lack of volatility is completely unnatural. It was a mathematical fiction. True skill lies in contrarianism. It is the capacity to develop a variant perception, holding a deeply researched view that diverges sharply from the crowd, and ultimately having reality prove your thesis correct. You do not find outsized returns by buying the prom king. You find them by targeting assets the crowd has deemed controversial, scary, and structurally unloved. That institutional repulsion creates the severe discount necessary for a true margin of safety. Value, price, cycles, risk control, and contrarian logic all build toward a single metric of investing supremacy. The absolute peak of the framework is asymmetry. Look at these two portfolios. Graph A simply mirrors the market, rising and falling in lockstep with the index. Graph B captures the vast majority of the gains during a bull market, but rigorously truncates the damage during a crash. This is the unforgiving math of compounding. If your portfolio drops by 40%, you do not need 40% to recover. You must generate a 67% gain just to get back to zero. By losing less in the downturns, you protect the base capital required to compound in the next cycle. Superior investing does not demand an impossible ability to predict the macroeconomic future. It requires the discipline to accurately diagnose the present market cycle, the rigor to demand a strict margin of safety, and the temperament to let exceptional defense win the compounding championship.